Welcome to the midweek market update where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. This week I also have 5 trade ideas to share with you towards the end of the video, so stay tuned. So jumping right into our S&P analysis, kicking things off with our sectors as we always do. Who was leading, who was losing, and where was the weight? So XLB led the pack today. Our builders up 1%, and energy down at the bottom of the barrel, down 1.63. As we know, neither of those two sectors really make up a significant portion of the S&P weighting. So what does? Certainly our XLK, the heaviest weighted tech sector there, up 0.5%, whereas financials, second heaviest weighted sector, up 0.14, and healthcare here up 0.63. No surprises to see a green market when a majority of our sectors are skewed to the upside. If you were watching intraday, you'll certainly remember that the XLK was actually up at the top of the list for a majority of the day, and the XLF was the exact opposite down here at the bottom. What I'm trying to get at is that the push and pull between the tech and financial sector is still very much in play. Let's check in on some of these charts and just ensure that risk isn't mounting in one place versus another. And my oh my, look at this XLK. To me, it's starting to look a little bit parabolic, right? This most recent leg is starting to curl something like this, as opposed to this action back here where we have a move up and then some consolidation. So to me, dare I say it, this is starting to feel a little bit overextended, right? So all I'm getting at is not an ideal location for any new longs, and the risk of a pullback to me is greater than a continuation higher. So on the pullback, if we get it, we're looking for support to come into play around 148.60 to 147.90. In this area, if it does come in, we're looking at a new higher low, and we can continue on the daily uptrend, right? This would be our last major low here, and this would be that new higher low. So keep a close eye on any pullbacks to hold that gap fill area. Obviously, the line in the sand is down here at 143.68, the prior breakout point. That's the absolute worst case scenario. If the XLK does experience this pullback, that's not going to be too hot for our S&Ps, and we'll see why, because if we check in on the financials, we've actually given back up our 36.61 area, right? This is a critical flush point, broke here. We talked about recapturing it and finding acceptance above there. But now on Tuesday, things have changed, right? We're back underneath it now. I don't think it's completely resolved based on this candle that's printed. You know, it looks like we're trying to poke our head back up and retest it once again. But 36.61, keep an eye on it. That, I think, is going to be a key to what the S&P does into the end of the week and the early parts of next week. If we recapture, that's going to bode well for more grind and continuation higher. If we roll over, obviously that paired with any sort of pullback in the XLK, as we just discussed, is not going to be so hot for your S&P. We'll check in on the TNX while we're talking about financial stuff. We're fulfilling that promise from last week's video. We finally got it right. But 10-year interest rate, it's clearly moving lower. FOMC was today just kind of holding after this aggressive sell there towards that 1.3. Obviously, the target would be down here around 10 for the interest rates to continue moving lower. And this is quite simply is bad for financials and good for tech, right? So that's going to continue to give you some push and pull across those two sectors. As it goes sideways, you get more activity just based on what the two sectors are doing. But this is going to throw a third sort of variable in the mix. Obviously, banks aren't making as much on interest, and the tech sector doesn't have to pay as much on the interest on the loans that they may have, so their margins go up slightly. So that's how that kind of works. And then we'll move back over to our XLV to wrap up our sectors and finish it off with the VIX in just a moment. So XLV, we talked about this range doubling sort of activity. Boom, there it is. We're poking our heads back up through it. I would say on any pullbacks, you just want to hold the 50% mark now of this new doubled range. So anything that looks like this, great for a higher low. Boom, take the breakout over 129, and that's going to bode well and sort of give that extra leg up in the S&Ps if XLV remains strong. I would say that there's still room to run in this one, unlike the XLK, because we've consolidated for such a long period of time in that range that we've discussed in the past. It doesn't take a rocket scientist to say this, but if we fail back into the range, the target is the low end of the range, and that would collapse sort of your S&Ps, especially paired up with that XLK pullback and or XLF failing at 36.60. So moving over to VIX now to wrap up sort of our behind-the-scenes stuff. And VIX, no surprises here, still extremely low. What I want to point out is that it felt like hot and heavy selling on Tuesday and Wednesday, but we never even came up close to that 2050 area, which we know is kind of what's required for a more significant down move across the market. As this sort of hovers closer and closer to that 15 floor, complacency builds in the marketplace. It doesn't have to happen today, tomorrow, the next week, or the next month, but if there is any sort of significant pullback, the longer we've spent at 15, the more likely it's going to catch people off guard, and it's going to exponentially increase what happens here in the VIX. So keep in mind the amount of time that we spend close here to that floor. So I know it sounded like a lot of doom and gloom here, looking behind the scenes at our sectors and the VIX and all that good stuff, but it actually is a pretty, decent 2 days that we've had in the marketplace, seeing 2 liquidation breaks. And the things we know about liquidation breaks are that they take short-term sellers out of the marketplace. So where did this liquidation break go? Did it do what it was supposed to do? Yes, it filled the gap underneath. So in terms of technical movement, that's exactly what we should have seen happen inside of the S&Ps. So check one for the technical traders. And this low here, where did this liquidation break go? To a very, very nuanced level. Not only was it this here, we'll talk about a market profile reference as we get to that section and why this is such a critical low. So 2 checks for the market doing what it should have done where it should have done it. So technical traders are in control of the market, short-term traders here, and we'll see why again as we get to the market profile as well as internals here in just a bit. So I think there is some room for this to slightly grind higher, right? The market has done what it should have done. If a stronger seller was going to step in, they wouldn't have cared about the gap fill. It just would have went boom, 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 and continued to hit all those references that we've discussed for so long in the weekly watch list. So to me, maybe there's a slight inkling, that the market does go higher, but be very, very careful. Use a tight stop in an environment like this. Let's check in on those internals now. If you're not familiar with this screen, go ahead and get familiar. Top right-hand corner is going to tell you what this all is, how you can read it and set it up, and how it'll help you make better trading decisions intraday. First thing to point out is the obvious divergence here in volume to red volume days, whereas our sort of ES, if we scroll this over, here we go, is actually, significantly green, right? We actually made a move higher here. The most concerning divergence to me is the ADD and the discrepancy here between what's happening on the exchange level versus what our S&P was actually doing. So this one's kind of raising a question mark, but as we know, short-term traders are in control of the market. It's not like people are putting on huge positions here inside of these summer trading months, essentially. And then lastly, the tick. I think this one is the most telling, and this will help you out if you have the cumulative build here. Whenever this returns back up to 0, that's telling you short-term traders are in control of the market. If a larger seller was, present in this marketplace, it would have done something like this, as we know, and then flattened out and, hovered around minus 2,000, minus 2,500. But instead, you can see it returned to 0 here, and this is a huge one, right? If you're seeing a cumulative build on either side, something like that type of activity, huge tell that short-term traders are in control of the market. There is not likely going to be any sort of major initiative trade on a day like that. Let's jump over to our market profile now and talk about what's going on here and why this level, the low of today essentially, was so critical, right? If we look to the left, where was that level? Right to the prior day's point of control. Where was this prior point of control? Look left again. Right to that exact low of the Friday before the holiday weekend here. So this is very technical, nuanced trading. And again, another clue telling us that longer term position traders, someone who's really going to come in and move the market, isn't quite stepping up and becoming active as it sits right now, which is again why we think the market could continue to just dribble higher as short-term traders remain in control. The last tell we'll sort of give is certainly this poor high that was put in. Ideally, we want to see a couple ticks of excess. This period here, A period, certainly good excess. The M period from this day back here, good excess. You'll notice that J only sticks up one single letter. So what does this tell us? It likely needs repair. So the first reaction is always to back off, and then you want to see it revisit and broken because again, short-term traders are the ones that have essentially created the market structure there. Short-term traders have weak hands, and it should break when it is revisited. Last thing I'll leave you with here on the market profile is that we had an all-time high set in a pre-market session, this one from back in here, and that has since been repaired, so all good in terms of that front. Let's flip it back over to the platform now, and talk about the rest of our broad market. The first thing is, of course, the Qs. Just like the XLK, I think the pullback risk here is higher than what we're seeing even in the S&P, right? I'd rather go long the S&P, seeing a couple days of consolidation and more sideways balance than the Qs here making a push higher. So to me, risk here for the pullback into the gap fill area and or support trend line. After that, this critical area of lows around 352.73 wouldn't be my first choice to go long, but we've discussed that in the past. IWM IWM up next. This one to me is signaling risk off, right? We've basically failed off of this double top. So if we grab this double top 1 and 2, here is your neckline, right? And if we go lower, the target's simply down there at 215 and the support trend line. One thing I would just caution you though is that we always remember that in the middle of a range, right? If we just do something like this roughly to encompass most of the range, if we draw the midpoint in there, you never really want to initiate a new position in the middle of the range. We've talked about this on the channel in the past, so just be skeptical of that. I'd rather see you sit on the sidelines and avoid a little bit of a short here than get chopped out and see this thing come back up because we're at that 50% mark. So just use IWM as more of a benchmark. As we start to break into blue sky territories, maybe that's a time where you use this as an instrument and actually trade the options and or shares on it. Let's get into these 5 trade ideas now. The first one is going to be on C for Citibank, and this should come as no surprise. It's going to mirror what we sort of have inside of that XLF. We have a sort of head and shoulders, right? Shoulder 1, head, and shoulder 2. The neckline here is a little bit better defined, something like that. Basically, the other way to look at this is simply an H pattern. So we look for the breakdown of that double bottom. You know, a reason why we're also liking this is pretty aggressive red candle, right? And on this bounce, it's not like we recaptured a bunch of that range. It's more of a resting bar, just kind of acceptance of prices lower. So if we take out 67.29, the target is down below at 64 the whole dollar. Reason being, if we scroll back a little bit, that is technically the top of this gap. It offered some support as well as some resistance in the past. So there's some price history there. Keep in mind 200 SMA, as time goes on, will start to coincide for a super support at that area. Earnings are around the corner on this one, so be careful if you decide to take this trade with options. Next trade is going to be on PFE, so PFE for Pfizer. PFE, not CPFE. There we go. And this is simply a ascending triangle and or bull pennant, right? You could look at it something like this. There's your bull pennant. You know, if we take out the pole portion there, just this is your ascending triangle. Hammer formed off of it and just below the 50 SMA. So I'm basically looking for a move back up towards this 40-31 area. You can see strong resistance in the past. You know, if you don't want to take the trade off the support trend line, then fine. Wait for another higher low. Boom, take the break. That could potentially send it much higher, back up towards those highs around 43 the whole dollar. Wouldn't really be interested in this trade if we start to find acceptance underneath that support trend line there. Next trade idea is going to be on BA for Boeing, and this is simply a move to another support trend line. If we zoom in a bit here, you know, pretty aggressive selling into it. We had a couple of lower wicks at first. So, you know, based on the lower high, I also have some feelings about the travel industry being slow from what I hear. So, you know, not much of a fundamental trader, but that just, you know, hearing about that doesn't really excite me about getting long BA. Basically, if we really fail underneath the support trend line, look for a target down below around 221, 220. So basically a $10 move available really on the flush of 230, really confirming that the support trend line has broken. Keep in mind 200 SMA will be there to meet us as a super support. You could either wait and you know, take the long off of that, or you could take the short on the breakdown. Earnings on this one are a little bit further away. I wouldn't really be interested in the short if we start trading above that 50 SMA on the daily time frame. Next up, we have Walmart, and this I believe is a very similar setup to what we had on Tesla just a little while ago, where we had this sort of gap up balance, right? So a lot of inside bars stacking and a huge inverted hammer here, large upper wick, indicating that buyers aren't really ready to step up and take this higher back up to this area of the chart. So what do we look for? Probably the next area down below. If we flush underneath, let's just put a value to this. I think that's around 139.30. Yep, somewhere in here, basically the low of today. I would watch out for this tiny little gap to fill all the way around 138.50, and then kind of this area of choppy support, right? If we do something like this, here's prior support, here's some resistance, here's some support. So basically 137 could be a more extreme downside target. Your stop in that case, if you're really swinging for this, would just be over the high. So, you know, that's about I would, you know, maybe 1.5 to 2 to 1 risk to reward ratio here available in Walmart. On the day trade scalp, obviously your risk would be much tighter. Let's get into our last trade idea here on eBay, so EBAY, and this is simply a daily bull flag, right? It looks phenomenal here. Nice strong uptrend flagging activity. It looks like we're trying to reapproach and reattempt that high there set at 70.77, let's call it, just for round numbers sake. Would not be interested in the trade if we fall underneath our 69 whole dollar. So basically looking for this, either further consolidation and boom, take out the highs to move into blue sky territories, or we do something like this and just off the radar in terms of trading this into the future. So that's going to wrap up this week's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section, or by simply leaving the video a thumbs up. That being said, I wish you all a green trading week.